if you asked me whether we would see perps in the US 3 or 4 years ago, I was like, I don't know. I think this is going to take a very long time. I don't know if this is going to happen in my lifetime. And here we are.
I think what you're seeing, which is really interesting if you can step away from it, is the traditional financial system reacting to the innovations of crypto. Perps is a good example of that, right? They are seeing the pressure coming from what crypto is providing.
I think crypto and stablecoins and tokenized assets are probably the first threat to this extremely well-established model.
Be characterized as participating in unregistered swaps. But the CFTC didn't simply bless offshore perps for everyone.
Nothing said on inflection point is a recommendation to buy or sell securities, tokens, or any other assets, nor does it constitute a solicitation or offer to invest in any fund, product, or financial instrument. This podcast is for informational purposes only. The views and opinions expressed by hosts and guests are their own and do not necessarily reflect the official positions or views of their respective employers or affiliates. Hosts and guests may hold positions in companies, funds, tokens, or projects. Hey everyone, welcome back to Inflection Point. I'm joined as always by David Lawant, Matt Hogan, and Michael Marc Antonio. This is the pod for the institutional adoption of crypto. And if you're a first-time listener, welcome. If you're a second-time listener, I hope that you've subscribed already. There's a lot of information specifically to do with the institutional adoption of crypto. Speaking of which, I'm going to plug DAS, Blockworks DAS. So there's DAS Asia on October 7th in Singapore, and then DAS London in November 10th to 11th. These are, in my opinion, the best institutional high signal events of the year. And there's early pricing available right now. And as always, and I don't like when people message me on LinkedIn the day before, the week before, tickets will sell out, and I will not be able to help you out so close to the time. So please, try and get there early, and that's it for my little plug. Let's dive into the markets, guys.
And can I just say, like and subscribe to Inflection Point? Let's get that out early.
How are we feeling? I know the market's a little bit rough. How we spoke about this last week, and somehow the seas are even choppier. What's on you guys' plates? Maybe Matt, we'll start with you.
I just think it's going to be grindy for a while. That's my honest take. It's one of those, I've never been more bullish on the long-term outlook for crypto. And there's so many cross currents in the short term, whether those are macro, policy related, strategy related, ETH community related. I wish I could just give a full bullish answer, but I think it's going to be choppy. I will share one thing, Mark. I did more sales calls yesterday than I've done since I joined Bitwise in one day. I spoke with 8 different advisor teams, more than 40 different advisors. The probably the 2 interesting takeaways from that is they're still interested in crypto. So these are people who've been studying the space. They're not scared by the pullback. They want to know if the bottom is in. That's one fact. The more interesting thing I found is that they were interested specifically in stablecoins and tokenization, and not in Bitcoin, which I thought was a little bit of signal. Usually in a bear market, it's Bitcoin that leads us out. If you think the marginal buyer is actually an institutional buyer, I think it might be stablecoin and tokenization related plays that lead us out. This might be one of the rare sort of early bull markets where Bitcoin dominance falls because their interest was explicitly outside of Bitcoin into quote unquote the real world of crypto. 8 calls in a row, they said the exact same thing. And I thought that was an interesting takeaway.
Matt, how do they plan to get exposure to this real world of crypto?
They would love for me to tell them how. Look, I think they don't know. They're sort of feeling around the edges. There are 2 schools of thought. One is invest in an array of tokens that are related to this, hoping that one hits. So that means everything from ETH to SOL to Link. Maybe it means Hyperliquid. It means just sort of spray in that area and hope that it hits. The other thing that really did appeal to them were the companies. I think there might be a specific bid for crypto-linked companies that are using the platform here. So I told the story of Figure a few times, and that really resonated. Circle certainly resonated. Some of the financial giants that are playing in this space really resonated. So I wonder if the meta is not, actually the infrastructure, but the apps or companies that are building on this new blockchain base. That may be the story. There may be crypto asset related plays. I think Hyperliquid actually fits into that. Who cares? It's crypto, right? It almost doesn't matter. It's an application. I think that is probably where they're going to end up by and large.
Yeah, I think one interesting narrative that relates to what you just said is at the same time that you see news about AI actually being a lot more costly to business than was initially anticipated, I think it would be very interesting to see blockchain based technology integrated into TradFi or traditional businesses, reducing costs to businesses. I
Yeah,
think that counter narrative needs to take place because it's true.
I think that's absolutely true, right? And that's why Figure is such a great example, right? They cut the cost of issuing HELOCs from $3,000 to a couple $100. I think this application layer of crypto idea, or this cost reduction layer, or this using the infrastructure layer, I think that's an interesting story, and it really came across in these. There's something about doing 8 calls in a row, right? It's like an exhausting marathon, but you start to hear the same story repeated, and that's definitely one that came across.
I love it. It's time for the fat protocol thesis to die. Finally. Not that there's not going to be valuable protocols. There are going to be those, but I'm very much looking forward to an application phase of the market. I think we need that.
I mean, so far, I mean, fat protocol thesis or not, so far Matt's been talking about like publicly traded companies. He hasn't really meant, I mean, just utilizing it. There was a panel last year in DAS talking about how these companies, publicly traded companies, well-capitalized companies, are going to come, take the 10 years of free open source crypto code, and then just use that in their backend for the DeFi wallet.
Yeah, well, I think there's an element of that, but I actually think it's probably there's more disruption than that makes it seem like. So I think it may be new companies and earlier stage companies that use this better than the traditional financial firms. There is a real disruption taking place in the financial services business. I was looking at the largest, most valued private companies in the world. A lot of them are actually financial services companies. It's basically AI or financial services. It's Stripe, it's Revolut, it's Tether, it's Kraken, etc. Those are among the 50 most valuable private companies. So I agree with you, Mark. There's a little bit of like free riding on the built infra by TradFi giants, and I think you'll see that. But I think you're going to see more disruption from startup firms than maybe people are giving them credit for. And I think you'll see crypto infra get a bid. It's a relatively small market, right? They've already Ozempic the fat protocol thesis, right? Outside of Bitcoin, the whole architecture that we're talking about reinventing finance on is $500 billion, right? It's a small market. So that's already happened. So I'm still bullish on that space as well. But I do think a lot of publicly traded companies, including sort of crypto native companies like Figure and Circle, et cetera, stand to win a fair amount.
Yeah, I think, Mark, I think there's a distinction that you need to make between a company sort of forking existing technology for its own use versus a company using the public blockchain rails. If the former, it's not going to accrete to the broader crypto market. They're just going to basically be using blockchain technology in their own walled garden. But if, on the other hand, companies actually build on top of Ethereum or Solana or Hyperliquid or any of these other blockchains, it will be net accretive, despite the fact that they're now taking technology that has been built over the last 10 years and somewhat co-opting it. They're co-opting it in a way that's actually maximally beneficial to the overall network.
And which one do you think it will be? Don't say if you have to say a combination of both, lean towards one.
Okay, so in my view, right now, I think that Ethereum is well positioned to be the home of, I think Vitalik said, like, slow, boring finance. I don't think those were his exact words, but borrow, lend, basically the credit union, the global credit union, right? Whereas Solana and Hyperliquid, I think, are positioning themselves for high frequency trading, fast finance, where price discovery takes place. Ethereum, as of today, does not have the throughput or the speed to be able, I think, to compete for tokenized securities in any meaningful way. But certainly Solana does, and certainly Hyperliquid does.
Yeah, maybe more on the bond side, I guess, for Ethereum, something that's less traded, not stocks, not maybe more private credit. I don't know, we'll see. But Matt, you brought up Figure, and I mean that's something I also use to sell people on the vision. I did a report on them last year. You mentioned they cut the cost. Yeah, they cut the production cost of a loan by 93%. They cut the median funding time to give out the loans from 42 days to 10 days. And obviously, not all of this is purely based on blockchain. They're utilizing other advanced features as well. But I mean, it's a solid example of where the future is. And another example is SoFi. They just, they're a bank and they just launched their stablecoin. I brought this up in the group, and David, I said, oh, it's the first bank to launch a stablecoin. And David had some beef with that, saying, actually, no, Anchorage was the first bank. So I think I looked it up, and it was SoFi is the first national retail bank, technically, and Anchorage is actually the first. But we're mincing meat here. But what I think about, okay, so one, it's nice that a bank issued a stablecoin. That's all well and good. But what I think is interesting too is that SoFi also has tokenized deposits already. So there's always been this debate about which one is better, and the banks would have you believe tokenized deposits, and I guess everybody else would have you believe it's stable coins. I don't know if you all have any takes on this debate in general, or even just the SoFi launching their own stablecoin. Maybe David, who has the beef.
Well, no, I think it definitely speaks to how stable coins are reaching escape velocity. Our CEO and co-founder Nathan, he was at Consensus just a few weeks ago, and he mentioned that Anchorage, for example, has 20 large financial or tech companies on the pipeline to issue their stablecoin. So I think we're going to see a lot more of those. This is just the first inning. Of course, and there is this topic that we discussed many times here, that although the Genius Act passed mid last year, there is this long rulemaking process that will probably go until maybe end of this year, maybe beginning of next year. And I think as we approach that date, I think we're going to see a lot more interest. I think it speaks to that. There's definitely very interesting trade-offs to be discussed between a tokenized deposit and a stable coin, right? The way I think about the differences here is that, well, first of all, a stable coin runs on 100% reserve. A tokenized deposit runs on the typical fractional reserve system of a bank. Oh, there you got it. You have a good comparison.
There we go. Nice.
Over there. Look at that. It does feel like, I think the main thing here is that it does feel like maybe a tokenized deposit is something that can work well within a bank's walled garden, but that stable coins are something that travels much more smoothly throughout the system. These are two very interesting models. Let's see who wins. I think stablecoins has a lot going for them. The one thing I would say here is that the biggest flaw that is highlighted on this table, which is that stablecoins have no public backstop in a crisis.
Yeah, thank you.
And that tokenized deposits have the FDIC safety net, and that stablecoins do not. We discussed this in a previous episode. I think this speaks very much to the structure upon which stablecoins are built, right? Stablecoins are full reserve. So they provide a lot more security on that side. But yeah, it's definitely going to be a fascinating battle here to see who wins, or maybe there's going to be more than one, right? I can definitely see different use cases and different instruments being better for each here.
Can I just raise a question? Maybe somebody can help me with this. The criticism that get labeled at stablecoins is like, what about in a crisis? I mean, that's what it says right there. No public backstop in a crisis. But in a crisis, the backstop is the most liquid reserve asset in the world, short-term treasuries. Why isn't that crisis risk like 8,000 times worse on tokenized deposits? Because the backstop there is like a fake guarantee by the government that doesn't have to be there. Doesn't it have the same sort of velocity risk? Or am I missing something?
No, thank you. I put this shot up as from FinTech Brain Food, but I was going to bring this argument up, and it felt like they were searching for some kind of flaw to bring to stablecoins, but I don't have a good answer to that, Matt.
Yeah, I think that goes to the topic of what is acceptable collateral for stablecoins. And I think there's been a lot of attention within the Genius Act to what is acceptable collateral. I think here we're talking about short-term treasuries by and large. There are, I think, few other things that are accepted as stablecoin collateral. So things like bank deposits. So to the extent that a big part of a stablecoin collateral is on short-term treasuries, the way I think about these is that this is the most liquid asset in the world, right? If you're getting to a point where these markets are under stress, you have probably a much deeper problem. So yeah, I agree with you, Matt.
Can I ask, why do tokenized deposits need to sit within the bank's perimeter? And I interpret that as saying it needs to sit within the bank or the bank network on some sort of walled garden private blockchain, not freely tradable on public blockchains. Is that just compliance reasons? Or is there something actually inherent to a tokenized deposit that limits its ability to act as a liquidity source on chain?
It's purely regulatory. David, you go ahead.
Oh yeah, I was gonna say it's probably a regulatory thing, but there's also a risk factor to this here, right? Because when you're buying a tokenized deposit, you're literally underwriting the creditworthiness of that bank. So like I would imagine a market of tokenized deposit a lot like the interbank market used to look in the past. Is not as an active of a market today, right? But I feel like there's a credit risk component here and credit underwriting component.
But aren't I underwriting the credit of Circle when I use USDC to some extent?
Post Genius Act?
Well, maybe not post. Well, even post Genius Act, you're just appealing to the law and saying, Circle needs to be doing these things or else they're in violation of the law. But I mean, technically, right? Like, if they're in violation of the law, or if they're not doing the right thing, there could be a run on, theoretically, on a stablecoin issuer just as much as there could be on a bank, right? Or not?
Well, I mean that's assuming two different things. One is assuming fraud, right, and the other is assuming fractional reserve banking, which is just the reality. Sure. Like the money is just literally not there at the bank, and you can't get rid of fraud, but
of course.
But I think they're materially different. I actually worry a little bit about a run on tokenized deposits because the velocity is so fast in these ecosystems. You can see an SVB style thing happening at real speed, and then sort of getting blamed on crypto. Whereas I see the whole stablecoin thing is so strange to me because it's like positioned as risky and it's much safer.
Right.
It's positioned as like anti-consumer and it's trying to pay yield to consumers. It's like everything is upside down when traditional people talk about the stablecoin market. It's very hard for me to wrap my head around.
I agree. I think the model will prove itself over time, and folks will start to get more comfortable. But I agree with you.
So just the reason banks like tokenized deposits and are pushing this is because they've got this superpower of money creation, right? And they want to they don't want to lose that. if they buy into the stablecoin game, they're essentially losing that power.
Yeah, that's exactly right. And they're forced to have a large deposit base by regulation, and they have all sorts of good reasons to throw FUD on the stablecoin space.
Yeah.
It's just strange to me that it's been so effective
Right.
at capturing politicians and public sentiment, and Bloomberg writing articles about stablecoins, being a risk, and the New York Times running op-eds about stablecoin being a risk, and they're just sort of missing logic that my 12-year-old understands.
Right.
Which is, if you have something backed by short-term treasuries, it's going to be fine. I don't know. It's very odd to me, but yeah, it makes sense why they fight it, of course.
Yeah, I guess maybe they need to come up with these stories because tokenized deposits have an inherent disadvantage to stablecoins because they're not fungible, right? So you have a JP Morgan tokenized deposit will be different from a small bank XYZ tokenized deposit, right? So on stablecoin world, when you think about USDT or USDC, especially let's think about the Genius compliant stablecoins. When you are within one stablecoin issuer, these are all interoperable and fungible with each other. So yeah, maybe there's a few inherent disadvantages here. So maybe they'll need to come up with some maybe clever marketing, whatever, to overcome those things.
It's such a great point because this oneness of money is at the heart of like the Bank of International Settlements criticism of stablecoins.
Yeah.
And it's a false criticism there. But as you point out, David, it's a real criticism potentially on tokenized deposits. There isn't the same oneness of the money. So, yeah.
I remember reading that in 2022. I think they put that, the IBS put that out. But to on the other side of this, it was just announced this week that a consortium of the largest American banks are creating their own tokenized deposit network. And again, maybe this is an example of what we were talking about earlier. I assume they're going to use private rails, and it's not actually going to be a blockchain. I mean, a public blockchain, that is. But I mean, they're trying to solve that singleness of money problem and instead of having to underwrite an individual bank, you're underwriting the 20 largest banks in the world, which then you could maybe argue too big to fail. And then on the flip side, looking, again, I'm agreeing with you all, but looking for some criticisms of stablecoins. You remember back in 2023, there was the USDC DPEG because of choke. I don't want to get into the details, but there was a gap between the redemption window on the weekend and you not being able to arbitrage it because it was closed, and people panic sold because maybe they didn't understand how if it was backed or not. I remember at the time thinking, I need to buy some USDC, going to my wallet, and all I had was USDC. I had no tether, so I couldn't make that arbitrage without actually liquidating some crypto assets. But this is what I'm thinking of, maybe some of the fears that have gotten into people, and then especially with Jamie Dimon being maybe perhaps more vocal now than before. He gave an interview where he criticized Brian Armstrong. He called him some names, and I think after Senator Cynthia Lummis said that she either thinks that Jamie did not read the updated version of the bill or is intentionally misrepresenting what it stands for now. So what do you guys think about that?
I mean, on the stablecoin front, it's absolutely true that we suffer from the original sins of stablecoins. Like if you go back to the very early days of Tether, it was really pretty dodgy, right? You had offshore payment processors. I think arguably they probably did lose $1 billion and then got bailed out by the Leo token. I think all of those things are probably true. And one challenge we have is that reputation stays with you, even as we get into a Genius Act era where they're truly backed one for treasuries. So to some extent, we are sort of paying for the challenges of the past in the confusion of today. My guess on Jamie Dimon is he's deliberately misrepresenting it. That'd be my guess.
Yeah, and I guess the other thing is that banks never had any threat to their core banking business in generations, in ages. And I think crypto and stable coins and tokenized assets are probably the first threat to this extremely well-established model, but it's a more efficient one. So we'll see how it wins. I think it's normal for some of these banking institutions to distrust new innovations that are coming to the market, and I think it speaks to the importance that we're gaining in the market at the end of the day.
Yeah, I'm not super interested or concerned about this consortium, assuming that it is just an intrabank, almost payment or settlement layer, right? To the extent that it makes banks more efficient, that's great. But I don't think it's really going to touch outside of banks, as far as I know. I don't know if you've heard any different.
No, I think that's right. Look, I think what you're seeing, which is really interesting if you can step away from it, is the traditional financial system reacting to the innovations of crypto. I think this exchange network is a good example of that. I think NASDAQ and NYSE trying to go 24/7, 365 is a good example of that. I think CME and others developing Perps is a good example of that, right? They are seeing the pressure coming from what crypto is providing, and they're trying to respond. I think towards what Mike was saying is if it's limited in their response, right, then it won't ultimately win. It can't compete with the true global open network, which is sort of the classic innovator's dilemma. Like I see the threat coming, I take a baby step towards it to address it, and I get crushed. Right? That is the classic. That's not a guarantee that that will happen in finance, right? It's worth noting that the financial services industry has been the least disrupted by technology of any industry in the world. J.P. Morgan was founded in the 1870s, and it's find another industry where the largest company was founded in the 1800s, right? There just doesn't exist. So they're very good at protecting themselves with a regulatory moat, but they do see the disruption coming, and you can see them trying to respond to it. It's fascinating to watch.
Yeah. I guess another example of this movement towards it is the CFTC's allowance of bringing perps onshore. That was actually a pretty big one. I mean, and there were two different stories to this. One was actually, allowing Kalshi, they applied for it, allowing them to have their BTC perps, and others to apply for it as well. And I think Kalshi's applied for 12 other altcoins yet. I don't know if any have been approved or what the timeline for that is. And then the second story was using existing regulations to help US entities or bring offshore perps onshore. And in this particular case, it really helps Coinbase with their acquisition of Deribit. That was earlier this year. Was that earlier this year? It seems like forever ago. With the acquisition of Deribit, now bring the largest offshore options network onto US soil. So, I mean, David, I know you have some thoughts around these stories.
Oh yeah, this was a massive milestone in the industry. All the derivatives lawyers I know, for them this was like Super Bowl. This is like earth shattering, because there's a few questions that have been lingering with regards to perps that I think were answered in these statements. But also I think we can see this nothing short of the first steps of us seeing perps in the US, which honestly, something, if you ask me whether we would see perps in the US 3 or 4 years ago, I was like, I don't know. I think this is going to take a very long time. I don't know if this is going to happen in my lifetime. And here we are. The main thing, and Michael might know a little bit more about this, is one big thing that folks are paying attention to is that the CFTC clearly stated that these specific instruments, right? So we're not talking about perps in general. We're talking about one specific instrument on the Kalshi side, which is the Bitcoin perp that they're getting listed in the US. That instrument is a futures contract, and this might sound like a technicality, but again, for derivatives lawyers, this has been this massive statement, because there has been a question on whether perps are either swaps or futures contracts. And I think you can argue that they have characteristics of both. And in previous statements, the CFTC has characterized perps as swaps. And again, this might sound like a technicality, but it's not, because whether you fit in the swap or in the futures bucket, this has massive implications on to whom, which types of investors you can offer this, what kind of leverage you can offer, what is the whole like regulatory framework that you operate under. Swaps are instruments that are much more fit for institutions. Futures are instruments that are much easier to distribute to broader retail. So this statement that perps can be categorized as futures was massive. The other thing I found
David, sorry to cut you off, but before, can you? I didn't realize there was a debate between the two. I thought it was just whether they were futures or not, and they were looking at the funding rate. But how? I'm still rocking my head around it. How could perps be considered swaps? What features give it that kind of characteristic?
Yeah, so that, I mean, not a lawyer, not a specialist, so I'm not sure if what I'm gonna say is gonna be 100% accurate here, but there are, I mean, I think it's relatively easy to see why perps can be characterized as futures, right? Because they are standardized instruments. They are instruments that you can open a position and then you can sell a position to close the previous position you had. So like they operate a lot like futures. I think the reason why they can some folks in the past used to categorize them with swaps is because of the way they structure without having this terminal expiration date, and then just having these quote unquote cash flows, right, exchanged over time to basically peg the price of the perp to the price of the spot asset. Some folks would argue that this looks like a lot like a swap, right? Because in the end of the day, a swap is an exchange between an exchange of cash flows between two counterparties, right? But I think you can make an argument that the swaps market is essentially a bilateral market, right? A swap is basically an agreement between two parties. You don't have this concept of a listed product that everybody can buy and sell at an exchange. So, but I think that's the thing that in the past has led some folks to say that perps have swap characteristics, and that's probably why the CFTC has explicitly stated that perps are swaps. In a few, those were mostly, I think, in enforcement cases. It's not like that the CFTC was actually discussing specifically the viability of perps in the US, but those were like enforcement cases. And then the CFTC, in order to justify their jurisdiction around those cases, they had to say why they have this power, and they basically did that by saying perps are swaps. So it wasn't like that deep of a discussion, but this has happened a few times over the past, I don't know, 3 to 5 years or so. So now we're I think way more firmly on the futures territory.
David, is it at a 50,000 foot view? Is it easy enough to say that before this, futures had to have a date, and like now they don't have to have a date by which they expire, right?
Yeah. So we probably need to bring a derivatives lawyer to the pod, but I actually don't think that there is a formal definition of what a future is in the Commodity Exchange Act. Because
No, there is.
But it's kind of recent, right? Or I don't remember exactly the issue here, but I do know that the CFTC, they operate more on a principles base, while, but let's say the CFTC works under these more strict rules. So maybe there's a little bit more flexibility here. Maybe you know this, Michael, better.
Yeah, I mean the CFTC is governed under the Commodities Exchange Act, and the Commodities Exchange Act regulates the definition of futures pretty strictly, actually, and it requires futures historically to have a set expiry. It has other rules that the CFTC has fashioned for margin requirements, limits, etc. But the big one was that a future under U.S. law needed to have an expiration. In fact, all derivatives that could be characterized as futures needed to have some sort of expiration. So what you saw with some issuers like Coinbase was they would make the expiration like 5 years in the future, right? So as to like sort of preserve the perpetual nature of it. But Yeah, they're one of the problems before the recent CFTC news that we're talking about here is that perps were illegal under US law for a lot of reasons, but one of which was just that they didn't fit into any sort of regulatory regime because their characteristics were totally unique relative to what had always been contemplated. To one other point about why a perp can look like a swap, and I think David described it beautifully. But traditional futures usually have a defined expiry, and when the CFTC they requested comment, and they for like some guidance on this question, and they highlighted that perpetual derivatives differ because the pricing relationship with spot is monitored and settled on an ongoing basis, often multiple times a day, with less need for a specific termination date. And so they said that feature they were thinking makes a perp easier to analogize to a swap, because a swap is often understood as a contract where parties exchange payments over time based on a reference price, reference rate, price, index, and a perps funding leg can resemble exactly that. So what they're trying to do is see in the first instance where they can fit this in. Now it's incredibly important that perps don't get characterized as swaps, because it would then be relegated into a much more restrictive regulatory regime, with much more onerous regulatory rules. So the swap regulatory apparatus requires, it, it requires a bunch of licenses and market structures, rule books, intermediaries, customer protection rules, and all these different access channels that would make it quite burdensome for anyone to comply with under the current, market structure.
Yeah. What I can say for sure is that swaps are bilateral agreements typically, so they're heavily used by institutions. You have these ISDA agreements, which is kind of a master agreement that it takes a very long time to negotiate, but then after you're done with that, you kind of can operate on a kind of ongoing basis. But those are done on a counterparty by counterparty basis. So it's a place where like a lot of the big institutions interact with each other, but it's definitely not an instrument that is probably fit for retail. And I think that's the big the big distinction.
That's definitely true. One reason why the current swap regulatory regime works is because they're not typically fit for retail, and therefore most retail is not clamoring to buy swaps. But when you have a product like perps where retail, it seems to become it seems to be the preferred way of trading for many people in retail, to sort of now require, let's just say, I'm not saying this is happening, but to require an ISDA would just completely torch the entire market.
And I think the other thing that's interesting is that the CFTC, I think they made a public comment request maybe a year ago, even before Chairman Selig was in office. I think that was on Carolyn Pham's day, and then they did a pretty thorough information gathering. And I read some of those letters. Actually, they're very interesting. And the one thing that it seems that the CFTC was careful enough to do at this time is that, hey, we are approving this one single product. And they seemed relatively reluctant to put certain classes within a perp, I think mostly agricultural commodities. So there's a very interesting discussion here on whether perps are an instrument that is basically good for anything, or there are a few commodities futures that would be better served by a dated futures format. I have a view on that, but yeah, that we don't need to get into. But I think the most interesting thing about perps is that, again, kind of what we're discussing on the stablecoin debate, perps unify liquidity. When you are in the dated perps, in the dated futures market, you guys know this well. Well, you have the front month contract, and then 2 months, and then 3 months, and then whatnot. And all this liquidity is fragmented through all these different contracts. Sometimes if you want a longer dated contract, you're going to incur in liquidity risk because that's not the contract that is being traded right now. So perps kind of do away with that because you have only one perp contract trading that doesn't have any expiry. I'm not saying that perps are the best instrument for every single asset. I kind of agree with the CFTC reading here is that there's probably a few assets, especially the ones where you want to take physical delivery, that the dated futures format is interesting and potentially maybe even better. But I do think it's kind of very cool to see and a massive milestone that we're kind of opening the doors for Perps in the US.
Yeah, 100%. And thanks both for explaining that little swaps versus futures difference. I'm kind of seeing the swaps angle of it now a little bit more. Makes me wonder, we spoke about this on the pod too, but even the formulation of perpetual futures, that funding rate, that's not even necessarily mathematically backed. There's no like formal verification. It's just finger in the air, the exchange or whatever the venue is determines the funding rate. And I wonder if there was some mathematician to actually prove that how you can price these things, whether that could help maybe formally classified as a futures. Like maybe the 8-hour funding rate is an expiration and renewal at the same time. But I'm kind of digressing there. And then I thought it was also interesting that about, you mentioned the CFTC also had let's just say a no-go on the agricultural products. The Clarity Act also says something similar in terms of, some commodities can be tokenized like gold and silver, but other agricultural commodities, they couldn't be tokenized as easily. They would have to go through higher levels of regulation if you were to put them on a blockchain. So I think it's interesting that they make these distinctions. In one case, I'm not really sure why, but you said, David, that you had some further thoughts on what might be the best product or might not be the best product for agricultural commodities.
No, I mean, yeah, I want to delve too much into this, but and some of the letters when the CFTC asked for public opinions, a lot of them from actually Perps players actually explicitly acknowledge that. Imagine you are a corn producer and you want to sell a certain amount of corn by, let's say, 3 months in 3 months. When you do a dated future, you're setting your price at exactly that amount. And then you can be sure that the contract will be settled at that specific price that you mentioned. If you replace that by a Perps contract, you're basically replacing that by a contract that has infinite duration, which is good because it gives you flexibility on the expiry here. But on the other hand, you are incurring this funding rate that is variable. And so you basically, it's very hard for you to actually fix a certain price at a certain point in time. So that's one thing. And then the other thing that I believe is more obvious is that although most derivatives contracts are financially settled, there are derivatives contracts that are physically settled. So if you actually need that market, then probably a dated future contract is the best construct to have. So I kind of don't disagree with the agricultural exemption, at least for now. Yeah.
But I guess the question, I'm no dog in this fight, but why not have both? What's the downside of allowing both?
It's a good question. Just me thinking out loud here is that you need hedgers on one side and speculators on the other for you to basically make a market. If you create a perp, probably all the speculators will move to the perp instrument, and then the hedgers will not have anyone to trade against. That's kind of my guess, but I don't know. It's a good question.
Interesting.
Go ahead, Matt. But then the funding rate would be pretty high, and then it would encourage the other side. But then maybe now you need futures for the funding rates to make sure that you don't overpay.
Let's just say that. I mean, we can go in steps, right? And I think that's a pretty prudent and pretty reasonable rule for us to abide by, at least for now, and then we'll see how things go.
I think that's very much correct. Yeah, I think it's a step.
The other interesting thing here is that Kalshi and Coinbase, they seem to have very different strategies on how to tap this market. right? To Mark's point, because Kalshi is listing a Perps contract in the US through a DCM, right? So in the derivatives world, a DCM is the exchange. Coinbase is using an FCM, which is kind of the broker in derivatives world, to access Deribit, which is an offshore contract. So I found it interesting that these two firms, I mean, these two initial forays in the Perps market are kind of coming from different angles. One of them is trying to build liquidity here in the US from zero. The other is kind of trying to tap international liquidity into the US. So yeah, just interesting to see here which model is going to win.
I'm glad you raised this point, David, because I think the mechanics are really interesting. So the CFTC didn't simply bless offshore perps for everyone. It created a narrow pathway where Coinbase, which is a CFTC regulated FCM, can intermediate certain Deribit perpetuals for US clients by treating those contracts as foreign futures, which they're allowed to do under Reg 30 of the CEA. And so this is the first time that US persons can interact with offshore perpetuals that is not going to be characterized as participating in unregistered swaps. And I think that's really important. I think it's important for two reasons. One is because it allowed Coinbase to sort of tap Deribit liquidity, right? I mean, this is why Coinbase wanted it. It bought Deribit. Deribit has the deepest liquidity. And rather than having to create a US Deribit and then fracture that liquidity, it's able to plug right into it. I think the second takeaway, for me at least, is when looking at how Hyperliquid can extend to the US, this seems to be the best potential option. There's not many good options for Hyperliquid in extending to the US outside of this one. Because if Hyperliquid has to create a US sub, it fragments liquidity and it therefore fragments their fee buyback mechanism, which hurts the token. They don't want to do that. And so I think this is a viable strategy for Hyperliquid. And I think it's going to be, and for that matter, for Binance, frankly, and for other foreign perp exchanges.
Yeah, that's actually a really good point. How I can see how Binance would do this. I can see how others. How would Hyperliquid do this? Like legally, structurally speaking, these others already have exchanges in the US, and they can just do the exact same thing Coinbase has now gotten permission to do.
Yeah, I mean, the way I would do it if I were Hyperliquid is I would partner with a already existing FCM in the US and that taps Hyperliquid liquidity directly, thereby giving US persons and institutions a funnel through which to trade directly on Hyperliquid. There are, of course, still going to be AML KYC questions, and this doesn't totally eliminate all of Hyperliquid's regulatory problems, but it certainly could create a much easier pathway. So I would partner with someone, but Hyperliquid could also just establish a US entity, apply for an FCM, get an FCM, and then plug it into Hyperliquid. But presumably Deribit, I mean, actually, I know this. Deribit, complies with AML KYC, right? Like they have a lot of the structures that any centralized exchange typically has, albeit offshore. So it was easier for them to do this than maybe Hyperliquid.
Yeah, I think that's a great point, Michael. Because at the end of the day, Deribit is regulated. I think they're regulated in Dubai, and probably the CFTC will have to wrestle with the question of how to allow folks to engage with a decentralized protocol. Again, next step of the conversation, right? We're clearing up the easier questions to answer, and then we'll get to these tougher ones as time goes by.
Yeah, I think the unique thing for Hyperliquid is, and this is different than on Ethereum or on Solana, is that they actually have the ability to do compliant AML KYC and and sanctions screening if they wanted to, because they control the protocol pretty tightly. The question is not whether they have the ability to do so. That is a question for blockchains like Ethereum or Solana. Like, there's not a really clean way for any protocol built on those blockchains to truly, well, I don't want to say it's not a clean way, but it's not really something that hits at the L1 layer. But for Hyperliquid, they could do that. Now, whether they want to do that is a separate question, and whether it makes good business sense to do that is a separate question. But I think they, like, from a US regulatory perspective, regulators would say you could just update the protocol, which they do constantly, right? To provide for sanctions clearance and screening, or AML KYC, or some sort of filters there. And that's what they would need to do, I would think, to be able to access US liquidity in this FCM compliant way.
Yeah, I think that makes sense. It would definitely be an off menu option though, right? So like if you're already regulated in another country, you're probably some part of some board of trade or something like that, which is the Deribit case. There's probably already a rule that allows you to follow this path. To interact with a decentralized entity like Hyperliquid, it might require some sort of rule change. So it's definitely a different process, something that might be more complex in the sense that we'll probably need to create a new rule to accommodate that. But yeah, I think it's definitely possible, and maybe we'll see that as part of the evolution of the market structure.
That's awesome. The CFTC gave us a little, and we're already talking about what's next. What's next? We want more. I mean, that's good. I love the ambition. So I know we're coming up on time here. We have a few minutes left. I did want to mention what's kind of going on in the markets. I know there's the Bitcoin, there's crypto in general. A lot of people are talking about Stretch, STRC, Strategies product. I do want to give Michael some kudos, even though I still do disagree with him. He did say that Michael Saylor selling Bitcoin, he was bearish on it, and I still think it was the right move, as he says, to inoculate the market. But I mean, I'll just pull up Stretch's chart here. We can see, I mean, it's not supposed to do this. We can see if a dividend yield increase, or maybe just time will stabilize it up again. But I mean, what do we guys think about Michael Saylor's strategy? Do we think, is this how he anticipated the market reacting to his very minor sell? And actually, when I say minor sell, I've charted it here. That is how much of Strategies holdings that they sold on that very one day, and immediately bought back multiple times over the next week. So what are we thinking here?
Well,
yeah.
So it was a minor sell because it was a test, right?
Yeah.
They wanted to test the market to see if they could sell. And I think the market resoundingly said they cannot, which is a pretty big problem for strategy. I can't imagine. I don't know how they're going to get around this, because if they do plan to sell in the future, or if they need to sell in the future, they're going to have to do a lot more work on priming the market for it, and a lot more. A Saylor's going to have to totally change the narrative that has been his bedrock for the last 6 years. Has been they're never going to sell a set, right? They're not going to part with one Bitcoin, and to go about face on that so I don't want to say so abruptly, but it was a little flippant, right? You mentioned it in on an earnings call that you might sell. You do a little test sell, and the market responded pretty violently to it. So I don't know. I don't know what their next step is, other than to just go back to their original strategy and say that was a mistake.
I think the other side there. Oh no, you go, Matt.
You go first, David. I'm actually going to take the other side too, but you go first.
Okay. The one thing I would say is, I think sometimes we have to try to untangle a little bit which market factors are here into play. And I fully agree that there was a negative reaction on the Bitcoin price once they sold 32 Bitcoin, which is I think at the time, to something like $2.5 million. But I was watching the tape really pretty closely during that day and then the day after on Friday. And and these are all just personal perceptions, right? It's impossible to untangle these things perfectly. But my perception is that the Michael Saylor or the strategy sale is probably what drove Bitcoin from 73K to 71K. That's more or less where I think the market was when the news started to spread. It probably had a $2,000 dip in price impact. But I think the big drop, the one that took us from the low 70s to the low 60s and at some point even under 60s, I think this was a much broader concern. Here, there's just so many factors at play. And if I had to say what was the most important of them, was probably the capital drain that the SpaceX IPO is bringing to the market. I think there's probably a lot of overlap between the holder bases of Bitcoin and maybe folks who would be interested in something like a SpaceX IPO. So I think there was probably this capital drain. The other issue is that on that Friday, we had this massive jobs positive surprise, which basically gives more credence to the folks who believe that there's an interest rate hike coming, and Bitcoin is negatively impacted about that. Actually, Bitcoin is especially sensitive to these things. On that very day, we also had Blackstone gating their leading private credit fund, I think for the first time ever. So I mean, there was a lot going on. The Nasdaq fell 4% on that day. So I'm not sure how much we can attribute to the drop in the Bitcoin price to the fact that Michael Saylor sold. But yeah, I definitely think that it had an impact. The other thing I would say, yeah, I'll just stop here and then I have more to say. But yeah, I want to hear Matt, and I see you're putting a chart here, Mark.
I mean, my basic thought is that everyone, in part because Michael Saylor and strategy talks this way, they talk in infinities. Everyone takes their action and extrapolates it to infinity. They sold 32 Bitcoin, they're going to sell 850,000 Bitcoin. They issued, $11 billion of preferreds or whatever. They're going to issue $1 trillion of preferreds. That's the way they talk. That's the way the market interprets these things. And so they panic. But over time, people get over it. Right? Remember, Michael Saylor hated Bitcoin, and then he loved Bitcoin. He was going to never issue an ATM share unless the MNAV was 2, and now he's issuing it at 1.1. He was going to do an infinite number of converts, and then he pivoted to preferreds. He was going to issue stretch to infinity, and now it looks like it'll probably be like 20% of the market cap or something ad infinitum. I basically think people overreact to almost everything strategy does. And the right way to think of them is as a capital allocator with like 10 different levers in front of them, and they'll pull different ones at different times. I think it's good that they have a sell Bitcoin lever. If they can sell 32 Bitcoin and then buy 1,500 Bitcoin a week later, I think they should do that forever. I think it's fantastic. So I just think of it as one more tool. And I actually do think it inoculated the market in the sense that I think the next time they sell Bitcoin, the freak out will not be as large, right? That's actually what the inoculation means. It means you do something, there's an immune response. We saw that. And then the next time the response is half as big. I suspect that will be true as well. If he sells Bitcoin and then buys more a week later 5 times, on the 6th time, we're not going to care that he sold Bitcoin. And I think that's actually what's going to happen over time. It's just going to be one more tool in his toolkit, is my guess. And all these extreme examples will fall by the wayside.
Yeah, I think to that point, I do believe that the narrative has been evolving. And I'm a firm believer, just like Matt, that selling Bitcoin can make a lot of sense in an institutional Bitcoin accumulation strategy, right? So this is not like hodling for your personal investment, just riding the cycles. What Michael Saylor has been doing is getting more and more sophisticated and having the option to strategically sell some Bitcoin in order to it's kind of literally the one step behind to move 2 steps ahead in the future type strategy. So I think it makes total sense to have that at the very least for tax loss harvesting, but I think it goes beyond that for actual risk management purposes. So I actually think it's an evolving narrative. It would be awesome if Michael Saylor had figured all that out when he started buying Bitcoin in 2020, but that's just not possible, right? I think Michael Saylor has said publicly that his ideal capital structure would look a lot more like equity and stretch, and not all the preferreds that he issued in between. But those are things that that's the journey that he had to go through in order to get stretch, which right now is the best vehicle to work at this time. So I think the narrative is evolving. It's fine that we didn't have the whole narrative figured out right from the get-go. I think that's how things actually work. That's how big businesses are built. So I'm totally fine with that. But I also understand that it's painful, right? I mean, the market doesn't like to see narrative changes sometimes, and whenever these are happening, there is this transitional phase that is uncomfortable. But I think we're going to end up in a much better spot.
I just don't think that, at least right now, strategy has the ability to sell any Bitcoin. I think that the tiny sale that they made and the market response, now we can say it was actually only from 73 to 71, and then there's all these other factors that drove the price down, and it had nothing to do with Saylor. I think the narrative is what matters, and everything I've been reading is blaming Saylor. I think that if you're advising Saylor right now and he wants to sell Bitcoin next month, what do you tell him? How much Bitcoin do you tell him to sell? I mean, the worst thing about the sale was actually that it was such a small amount. Like, if they needed the cash, they sort of sold more, right? At least then they could have funded their obligations. And yeah, there would have been a backlash, but I don't think it would have been any worse than what it was, what we've seen. So we don't know how much size they can sell, and we don't know how strongly the market will react. Matt could be right. I hope Matt is right that the market's inoculated now and they'll get used to this. I do think, though, that we are not fully appreciating how the market will start to perceive strategy if they start regularly selling Bitcoin from a DAT that is just an accumulation vehicle of levered Bitcoin into basically a Bitcoin risk management and hedge fund.
Yeah.
And I think that is a different underwriting exercise for investors that I'm not sure Michael Saylor is prepared to contend with.
I actually think that's a really good point. I agree with that fully. I have to hop, so we should dig into it next week. 10 minutes late, but I agree. Let's tackle that next week.
Sounds good. Thanks, Matt. Yeah, on that hedge, I think I agree with Matt. That's a good framing. And now it makes me wonder, and I think we briefly spoke about this after the pod last week. Why didn't Michael Saylor go for option selling? Why is that not one of the levers that he's pulling right now? And it doesn't need to be selling calls that are very popular, because it will derail his thesis about 20 to 30% CAGR Bitcoin appreciation over the next decade. But maybe selling puts. Maybe lending, these things he said he would never do, but we've talked about him saying stuff he would never do and then doing it anyway. So I'm not sure why these aren't some levers that he's pulling either. And I also wanted to, just bring up some context. I pulled up that chart, David, when you were talking, and it wasn't just Bitcoin that week. Bitcoin fell 17% that week, but a lot of assets had either their worst week or were in the 25th percentile of that worst week. So it could have been a broader market sell-off. I know, price dictates narrative, and if we look, we look at like Bitcoin's institutional demand here versus price and institutional demand. I've added ETF flows plus treasury flows, and it there's been a lot more selling than there's buying, and that simply put. And so I mean that's the state of the market right now. I know we're coming up on time and we're a little bit over actually, but I did want to ask both of you all, is the bottom in?
No,
No.
no.
How low do you think we can get? How low do you think we can get? And I hate number calling. I hate price predictions, but I'm just curious.
I'll take it first. I'm not going to give price predictions. I'm going to say that I am particularly worried about the macro climate. And I'm particularly worried about, I mean, I just got a notification that, Trump says that Iran downed a US helicopter and vows to retaliate. As long as this Iran Strait of Hormuz closure continues, we are just going to, it increases the risk that we're going to have a supply shock in oil. And with that is we're going to see inflation on prices. And that's the best case scenario, right? Like the worst case scenario, if this Strait of Hormuz or Hormuz closure takes place, is we actually start to see a significant disruption to our agricultural supply and many other U.S. client states throughout the world that rely on U.S. oil and U.S. protection. We're not going to be able to provide it. So I think, or sorry, U.S. Subsidy and U.S. protection. But of course, U.S. is selling its oil to the global market right now from its reserves, and those reserves are not infinite. So I'm particularly worried about that. I don't know if you guys have a view on it.
I think we're going to struggle with the current price levels for a while. I mean, we're right at the 200 moving average level, and I mean, we've been talking this since the podcast started. I actually remember in our very first episode, we were talking about the 60K to 80K band that Bitcoin will trade in. The encouraging signal is that whenever we get to the 60K level, we're a little bit under it. The amount of buy pressure that comes to the market from many different channels is kind of very interesting and very strong. So we can see this from the more institutional side. We see this at our desk. Michael is probably seeing this, or Michael's buddies at Galaxy's desk are definitely seeing a lot of buy interest that comes in when Bitcoin is trading in the territory that it is. You can look like in the broader market, the Bitcoin order book just gets skewed to the buy side very aggressively. So there seems to be a lot of buy interest at the 60K, give or take a little more or less here level. Having that said, I fully agree with Michael. The macro is very uncertain. And I would add on top of that the capital drain that all these IPOs are going to bring, right? So space we're recording this on a Tuesday, and I don't know when it's going on air, but SpaceX is IPOing at the end of the week. Anthropic is coming probably later in the year. OpenAI just filed confidentially for their IPO, which could potentially come further down the road. But the final thing I want to highlight on these IPOs is that they are kind of following the high FDV, low float playbook that we've seen in token launches, right? SpaceX is coming as this $1.7, $1.8 trillion company, and the equity issuance is only 80 billion. Of course, there's a lot of buy pressure from the index inclusion and all of that, but there's also probably going to be a lot of sell pressure because a lot of these employees and early investors, they're going to get unlocked relatively quickly. So I do think that these mammoth IPOs and probably a bunch of others that are also coming, I think a lot of these will continue to drag capital out of the market, and Bitcoin is probably a capital giver on this side. So you add that on top of the macro, we're probably going to be struggling here at the very least for a few months, I think.
What do you think about what the Fed's going to do? You think the Fed's going to raise rates? Mark?
I mean, I think they're going to have to. Not maybe at the end of this year, maybe Q1 next year. I mean, we're seeing inflation pass through. We're seeing PCE rising for the past 5 months. Some tariff effects. Oil inflation hasn't properly hit yet. But all of this is why I mean, maybe I'm being naively optimistic about the end of the war because I just see, if oil reserves draw down a little bit too much, if the war persists, there's midterms coming up. I just see all of it as too negative to sustain the war going on. And I'm hoping that cooler minds prevail, and we have, maybe it's not going to be a full reopening of the Strait of Hormuz like pre-war. I mean, I'm already seeing Iran talk about Hormuz insurance paid in BTC, which is an interesting dynamic in of itself. So maybe we don't go back to square one, but I just think that the downside is way too negative for us to approach there. And again, maybe I'm being naively optimistic.
I mean, I think you're completely correct. It's devastating. I don't know if the U.S. can do anything though, right? I mean, Iran wants to send a message not only to the U.S., not only to Israel, but to the world that you cannot do this ever again. And they seem to have all the time in the world. I mean, the mullahs do not really care that much about how miserable it is for their people in Iran, right? They're protected and they're still in control of the military. And so if you're Iran, why would you stop this closure? I mean, why would you reopen? Um, it's tremendously more destructive to the West than it is right now to Iran. When measured against the alternative, which is Iran continues to be attacked, right, and continues to be invaded. Iran wants to make sure that this is so costly that this never happens again. And right now, it's been costly, but it hasn't been significantly it hasn't been as costly as one might have expected because the US is such a large oil producer now. If it was not for that, this would be a much worse situation for the US already. It's already the largest supply shock in history. Luckily, the US is less reliant on oil than it was in the 70s when this happened last time. But we are still very much reliant on it. China right now is struggling, as far as I know. China is hoarding oil as much as they can. So, it might be interesting that to your point, Mark, the one hope could be China brokering some sort of deal to get this thing back open. But I've read that even if they open the strait today, we still have 6 to 8 weeks of no oil coming out of the Strait of Hormuz, right? Because that's how long it takes to travel over the oceans. So we could be in for a rough fall.
Yeah, and to clear out the minds and whatnot, and that's why I think, and I'm optimistic that it will reopen. But that's why I think that because it will take so long, and because the supply dynamics will take a while to get back online, we're probably going to need a rate hike. Probably going to need a rate hike at the end of the year, early next year, because of the inflation. We're coming up on time, David. Let me give you your last thoughts here.
No, the only thing I'm going to say is in a couple of weeks, we're going to have Kevin Warsh's first FOMC meeting. And that's going to probably be one of the most watched in a long time. I'm looking forward to covering that one with you guys.
Oh, yeah.
100%. All right. Awesome. Thanks for joining me, guys. Thanks everyone for tuning in. And once again, please, if this is your second, third time listening, like and subscribe, follow, 5 stars, Apple Podcasts, whatever device or platform you consume your media on. Just scroll it all the way. And we'll see you again next week. Yeah, smash it. Thanks everyone. Cheers.